It's easier to look through a crystal ball and predict the future. Alas, we don't have a crystal ball, and we're only prepared for what we know now and what we don't know now, and the things we know we don't know, and those things that we know we don't know we don't know. Amidst the sluggish performances by developed markets, falling oil prices and an energy crisis in South Africa, we've decided those who invest other people's money for some guidance as we enter 2015 with some trepidation. This is Tonight. I'm Bruce Whitfield. The lights are still on for now. Anyway, our lights are because we got a generator. Joining me, Chris Hart, investment strategist at Investment Solutions, and Warren Jeffery from Nedbank Private Wealth Stockbrokers to give us their take of what 2015 will bring, because 2014 turned into a bit of a dud, Chris Hart.
It was a dud. As the year progressed, growth forecasts were just downgraded for South Africa. It was downgraded for the world, really. And what came out was a stronger US. At least on the surface of it, and the more quantitative easing in Japan, effectively quantitative easing pretend or charades in Europe, and negative interest rates was a Rubicon that the European Central Bank crossed, and that still has to play out. But it's going to be interesting to see how this plays out. So South Africa really, you could say, was in a stagflation trap, and that's going to probably persist. Higher inflation with lower growth, but this next year should close a little bit. Should close? What do you mean by close? In other words, slightly higher growth and slightly lower inflation.
Well, that'll be nice, won't it? At least the oil price has been playing ball. But are you as sceptical, Warren, as Chris Hart is, about the turnaround in the US economy? I'm assuming you're sceptical. I just read the tone.
Marginally sceptical.
Marginally sceptical. Are you as marginally sceptical as Chris Hart is about the state of the US recovery? We've seen jobs numbers come through really strongly toward the end of last year. Wages for the first time also picking up. And that's got to be one of the earliest indicators that this is a real recovery.
I think I'm probably less sceptical. I think the US is finding traction. I think they are finding a way forward. From an investment point of view, is it the way to play it? That I don't know, because a lot of value has already been priced in. A lot of future growth is already priced into the US markets. But the US is the driver of our global economy at the moment. So I wouldn't say rush out and buy US stocks now. But in terms of the US recovery taking hold, I think it is taking hold. And I think we can look to your other regions, some of your emerging markets, and Europe to find the value to play that US recovery.
You know, Chris Hart used to be a teacher. He's got his teacher face on now. You're about to be admonished.
I've got no problem that quite clearly, if one just looks at the US, one's looking at a recovery. But we saw what looked like a recovery in the mid-2000s, and it wasn't a recovery. It was just a bubble forming because of what monetary policy was doing. So I'd be curious to see what of the US sustains once you start to normalize interest rates.
Okay,
if interest rates were 3% without quantitative easing, what would endure? And there's another little factor that's coming in, and that's a lot of their recovery has been on oil. Yeah. And that oil is not going to survive beyond too much longer if oil stays in the mid-60s. That's going to be a fact. So a lot of that growth might actually unwind itself.
So Chris Hart, you talk about bubbles rather than a recovery. The mid-2000s was a bubble, but isn't that the trend of recoveries, that they manifest as bubbles?
Well, no, it's not, because if you've got a sustained recovery that's actually grounded in fundamentals, that comes from the bottom up, I think you can endure. And we see this time and time again, but we've got economic policies increasingly driven top down, the trickle down effect where the bottom's not getting very much trickle, and you're actually relying on financial engineering to generate it. In other words, it's a consumption-led growth that they're going because they want people to have better asset prices. It's a wealth effect so that people can go and spend. The basis of the recovery is that people are able to borrow money and go shopping, and that is always ends in some sort of there's an end point that is never pretty.
Okay, are we headed towards an end point in this one, Warren?
I don't know if the bubble's going to pop. I think it might slowly deflate. I think what we'll find is business catches up to the spending. Especially if you look from a local point of view, people are still spending money and they're still taking on debt, but the kind of debt they're taking is changing. People are putting more debt into their homes, less on their credit cards. And for me, those kind of changes are positive. They're moving debt towards assets.
So in other words, They're effectively moving their credit card debt onto their home, paying their credit card debt off for 20 years.
But there
is an asset that will appreciate over time.
Well, but you're making an assumption that the asset will appreciate over time. If you sit in Papa Bear's corner over here, you then saying, hold on a second, if this is a bubble that is about to pop, there is no asset that has a sustained value. When asset values pop, and we saw US house prices take a big smack post-2008, it could happen here. I mean, that's where you're going with this, isn't it, Chris?
Well, not necessarily. All I'm saying is there's a lot of financial engineering, and if you took that financial engineering and the financial repression away, right, and had proper normal interest
financial
rates,
repression. This is financial emancipation. It's the printing of money. It's government largesse.
Exactly. You can print it, but you can't give it value, and that's the problem. That's why you've got the systemic risks that sit in the system.
Okay, so let's go through some basics. I want you each to give me 2 shares before we leave for 2015. You talked to us about us being stuck in a stagflation trap, but things improving, Chris Hart. How important are the ratings agencies going to be as this year unfolds, Warren?
I think the rating agencies, I mean, they always are going to be important, especially if, we're in an economy that enjoys foreign investment and that foreign investors view us through rating agencies. What I'd say is probably more important for us at this stage is not the rating agencies, but what they're looking at, and in particular Eskom and your power cuts, your load shedding. That is a big issue for any foreign investor, especially when our Treasury is promising to pay back debt or reduce deficit with economic growth. If we can't power that growth, we can't pay back.
We can't power the growth, but we get to run enormous cost at getting any sort of energy into the South African economy.
There's 4 expenditure bombs that we'd be looking at, and I think the rating agencies will also be looking at the public sector wage bill.
Yep.
All right.
We're going into a massively confrontational negotiation in the next couple of months.
But the trend in government, in any case, is to expand their footprint. The second is the national health, right? That is another expenditure bomb that's still lurking below the surface. That's still going to burst on the scene if they continue to push through with that policy. The third expenditure bombs are the parastatals. The parastatals, they need hundreds of billions in capital to actually meet those expenditure criteria. And the fourth expenditure bomb is nuclear. Each one can take us into more credit rating downgrades by themselves. If we tackle all 4 at once in a low growth environment, we're going to struggle.
Okay, so those are the bombs. When we look at the currency, which is also one of the great unknowns, it had, interestingly, in 2014, probably its least volatile year out of the last 10, although we did see gradual devaluation, and we saw it down to 6-year lows during December.
Yeah, we probably have moved on to the stage where the rand is going to continue to be vulnerable, and that we put in the context of the world, because it's not just the credit rating agencies where we're sliding down the actual assessment. It's the World Economic Forum, it's the Corruption Watch, Economic Freedom. All of these measures where you actually in a rank, we're busy slipping down these rankings, and that suggests the investability, the attractiveness, low growth, high inflation. All of these things need to be resolved, and we need to resolve what I call the 3 big mistakes that we're making. And the first big mistake South Africa is making is labour unrest, because no investor invests into labour unrest, not even the unions themselves. The second big mistake is the tsunami of regulation, right, especially when it comes to small business, because it requires economies of scale, and it's also diverting skills and resources to compliance when we should actually be diverting it to growing the economy. And the third big mistake are specific taxes that target capital formation and investment viability. When you've got capital deficiency, a growth problem, an enormous unemployment problem, things like capital gains tax, transfer duty on property, all of it, it's like eating seeds, but it's still expecting harvests, and we need to actually change that.
Okay, I'm about to slip my wrists. I don't know about you, Warren. Give me some hope, please, because in every period of adversity, every period of difficulty, there is opportunity.
Yeah, absolutely.
Where do you see opportunity for investors? Give me 2 shares. 2 shares. I'm like my 2-year-old. Give me 2 shares that you look at for 2015. You say, you know what, we can make some money out of these.
Look, I think, as you said, in the face of adversity, one interesting one to go for, and probably off a lot of people's radar, is Astro Group. They provide electrical generators. So in terms of covering load shedding and things like that, I think right now a lot of it's priced into the share, so I wouldn't rush out and buy it this instant. But on pullbacks, this is a good share going forward.
Okay. Astro is one. Take advantage of the darkness. Yes.
And I think
bring some light into the darkness.
Another one I like is probably Woolworths. I think Woolworths is a company doing a lot of things right at the moment.
Okay, good. We've got Astro and Woolworths. Where are you going? Goldfields and
Astro because
Astro
because Eskom is delighting us.
Yes.
Okay, right.
Right. Where are you going? Goldfields and Harmony.
Well, I would, in my personal, I put in a gold share or two. But as I say, you'll intimidate me out of that. So I'll choose two specific ones because both of them are rand hedges, but very, very different. The first is MTN. Yes. And I think that there's, it has come off because of Nigerians currency, all of that type of thing. And I think there is some, some resurgence, and it's emerging market African growth that you're actually gaining. And the second is not Harmony, Impala.
Impala
Platinum.
No, I mean, you talk about being in a stagflation trap. Do not get stuck in a value trap with an Impala.
It's possible, but I actually believe that we're going to see a bit of more further weakness of the rand, and the price of platinum is already below cost of production, and that has to rectify.
Okay, Warren, I mean, Impala?
Impala, to be honest, I mean, I like the share. My view is it's probably early.
And MTN?
MTN, I prefer MTN to Impala. No, I definitely think MTN as a long-term play is a good company to be in. The only risk would be oil prices low, as Chris mentioned. It's exposed to Nigeria.
What about Sasol? I was talking to Wayne McCurry, who's a regular on the channel, of course, and he was saying that relative to the valuation of the JSE, Sasol, as it is at its cheapest point in the last decade.
Yes, quite possible. But I think you need to see a resurgence in the oil price first, but there can be some recovery from a rand weakness point of view. So we're just going to see what happens. I have got bearish on the rand in that sense, but I am bullish, relatively bullish on economic growth, that I do think that we'll see a pickup, that it'll be more than what we saw in last year.
The cruelest and most unkind question of all, I'm going to ask you first, Warren, for a level for the rand on the 31st of December 2015. I'm going to put it in my diary and hold you to account. Give me a level.
I'm going to say 12 Rand 37 to the US dollar.
12 Rand 37, Chris Hart?
13.50.
No ways. But what about the argument that the rand is simply massively undervalued right now and it needs to stage a comeback?
If we don't fix our triple deficit, there's further weakness.
I don't want to talk to these guys anymore. I'm sure you don't want to listen to them anymore. Warren Jeffery from Nedbank Private Wealth Stockbrokers. His picks, interesting ones. Astro, take advantage of load shedding. Astro shares on a pullback. And talking about Woolworths as a company doing lots of things right. Bearish on the rand. It was 12 Rand.
12.37.
12.37 by the 31st of December. Chris Hart at 13.50 to the dollar by the end of 2015, with lots of fluctuations in between. Chris Hart, the investment strategist at Investment Solutions, is putting aside his gold shares, which is good, but looking at MTN as a recovery play for 2015 after the big sell-off we saw on concerns about Nigeria and concerns about currency devaluation in one of its biggest and most profitable markets. And then, of course, Impala Platinum, the big punt for 2015. There'll be more tonight, tomorrow. Till then, good night and goodbye.